Welcome to the National Credit Awareness and Resolution Association podcast at NACARA.org, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use Creditor Tools, specifically renewals, refinancing, extensions, modifications, forbearances. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Let's begin with forbearance. When unpaid loans mature, like a balloon payment, these are commercial loans, the creditor may require a full payoff, renew, or extend the maturity date of the loan for another period of time. It's likely the credit file will be refreshed with current financial reporting, something similar to the original underwriting process. Existing loans may also be refinanced with or without new money. The debtor may apply for a new loan to pay off an existing loan at another financial institution, called a refinance. Perhaps the terms and conditions will be more favorable due to competitive pressures, or, when a loan matures, a debtor will be fully prepared to simply repay the loan in full. On the other hand, in an economic downturn, a loan might be modified or even have to be restructured due to a debtor's temporary or maybe even permanent adverse financial condition, or possibly default. After all, they may be in both the creditor and the debtor's best interest to come up with another repayment solution. Any such modification or forbearance agreement would still need to be prudent. Otherwise, the loan might be liquidated with or without the cooperation of the debtor. Creditors will always be looking out to see any red flags that shows the debtor may be experiencing financial trouble. For consumers, red flags may mean a job loss, the loss of a family member, or a medical or health setback. The loan modifications or workout measures may be installed if the debtor maintains both an ability and willingness to make repayment. The creditor is supposed to be prudent, such that these lending measures or decisions are safe and sound. Loans that are restructured can have additional borrowings added or subtracted, including additional collateral. Let's talk about strategies during serious economic downturns or red flags. As repayment issues are identified, it's possible for the creditor to enter into a change in terms agreement. You see those all the time. Or some other forbearance, modification, or workout agreement can be used to provide temporary postponement of the creditor's remedies to cure a condition of default. The agreements will outline certain conditions the debtor is expected to follow, and if not followed, the agreement automatically terminates. The wording in the agreements will cause the debtor to acknowledge that a default has occurred and not waived, and may include language that releases the creditor of any potential lender liability. During difficult times, in particular, debtors need special attention, but debtors also need to be empowered to come up with their own repayment solutions. Now, typical red flags facing stakeholders include the borrower and or guarantor having insufficient cash flow or global cash flow. There could be delayed construction projects or those that are no longer viable, slow-moving inventory and accounts receivable collections, lack of timely financial reporting, loan covenant violations, declining financial ratio trends, excessive high loan-to-value ratios on collateral, more competitors, slowing sales and increased expenses, repayment that is dependent on the sale of the collateral, and other well-defined weaknesses or worse. What about a partial charge-off or a write-down of the loan? In other situations where there is reliance on the collateral's value, the portion of the loan that is insufficiently secured by the collateral and that cannot be supported by the available cash flow may ultimately be charged off or charged down. The interest accrual will be placed or remain on non-accrual status while payments are collected and applied to the principal balance, even though the lender will still show you the total balance and all accrued interest. The remaining portion of the loan balance still on the books will have to be well supported by documented available cash flow, pro forma cash flow, and appropriate collateral coverage. There are several factors that must be in place before the remaining loan can be returned to accrual status. After successive loan repayments have been demonstrated, like 6 months or so, it is possible the remaining loan could be placed back on interest accrual. Once the outstanding balance is repaid, payments will be applied as recovery payments towards the unpaid balance of the charged-off loan, and ultimately include unpaid interest. The creditor's accounting for the loans, including any charged-off portions, is solely an internal accounting matter. As for the debtor, he will continue to get monthly payment statements as if nothing had ever changed. It will appear the same even though there may have been prior charged-off amounts, changes to the interest rate, accrual status, etc. Just the creditor will be required to conduct certain accounting procedures for reporting problem loans on the books. This short ad is sponsored by the Debt Crisis Problem podcast. Attention listeners, please join us at tunabudget.com to tune into the Debt Crisis Problem podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. Let's talk about last resort options. In some scenarios, and as a possible last resort, it may be prudent to restructure the loan using any necessary combination of disclosable loan modification tools. Again, that includes like principal forgiveness, interest rate reduction, other than insignificant payment delays and term extensions. A defaulted loan can also be split into two loans, like we were talking, one that's kept on the books and the other that's charged off, and the latter can be repaid once the active loan is repaid. Customary terminology for this arrangement is A and B notes, or loans. Again, the A loan, legally enforceable, would be that portion of the current outstanding loan that is reasonably assured of acceptable repayment performance per the new terms thereunder. It would be structured such that it would be sufficiently supported by the then current available cash flow. Of course, the B loan is the rest of the original loan not included in loan A. It would not be a bankable asset and would be charged off the creditor's books. That doesn't affect you and your liability still. But once the A loan is repaid, however, the debtor can start repayment of the B loan on reasonable terms. So why is this risk important to you? First, give yourself plenty of time. But it's time to get to work now. Note that timeliness is very important for entering into loan modification, forbearance, or workout agreements or arrangements. You know when your loan matures, right? You also know how long it might take for you to prepare a workout plan to the creditor too. It means you having had sufficient time to prepare your financial statements, identify the root causes of the decline in your financial performance, and more importantly, the preparation of your pro forma cash flow statement. The pro forma will have to be well supported by assumptions, since this is the future cash flow based on strategic decisions to remediate the weaknesses heretofore experienced. Those assumptions have got to be well documented. These corrective measures may take at least 30 days in some cases. It may take longer if you have collateral issues and the creditor has a list of items that he wants or needs too. So if you have an upcoming maturity and you know you'll be having to prepare and present a repayment solution, it could conceivably take up to 45 or 60 days. So be ready. What about the time the creditor needs to do its underwriting approval and documentation work? There may also need to be a meeting or two, and that could take a few extra days. Or more documentation requests from the lender. It's going to happen, right? Realistically, though, you need 45 to 60 days, and the creditor needs 30 days. So you're looking up to 90 days in advance of the loan maturity. So it's time to get to work. Do not put this off. Next, how would it feel to be fully prepared? We talk about empowerment, you creating your own repayment solutions. In an economic downturn, your creditor may be swamped with deals that also need urgent attention. Not to mention that unexpected events may come your way too. You know you're not going to get enough of the lender's time and attention you deserve or want anyway, right? Could you imagine if you, a prepared business owner, came in with a workout package that included the necessary items outlined in all these credit risk memos? Do you want to shock your creditor? Okay then, just come forward with a solution to your own repayment plan. You go in with well-supported key assumptions, just exactly like I said, and in your pro forma cash flow statement, and with identified root causes behind the deficiencies recently experienced, and so much more. You present it all within 30 to 45 days of the maturity date. Talk about building credibility, right? Trust and transparency. How can you lose? I don't think you can. See it happen in your mind's eye right now. Thank you for joining us. Today we covered the Creditor Tools, refinancing, renewals, extensions, modifications, forbearance. As debtors prepare to propose their own repayment solutions, we want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at nacara.org. If you found today's episode helpful, please subscribe for future notifications. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.